listening to Consulting Logistics, presented by Aborn & Company. I'm your host, Tim Dooner. Thank you for joining us today. Oh boy. It's no secret that 2018 was a real son of a gun for a lot of shippers. It was our first full year of ELD implementation, e-com boomed, capacity busted, shipper of choice became a thing, inland rates hit historic highs, and the USA signed new trade agreements and waged tariff wars over disagreements. But through all of those growing pains, what emerged has been our first real look at tech's potential and the capabilities that a digitized supply chain can offer. Even the carriers, right? The carriers, often thought of as the strictest adherents to orthodox Ludism, soon saw the value that ELDs offered them in terms of analytics on bad shippers who tie up capacity by holding up their trucks with excessive dwell times and detention. Data that they used to remove capacity from bad actors. 2018, we saw automation, machine learning, blockchain, IoT, and warehouse robotics take incredible strides forward. We now have a marketplace filled with monolithic supply chain industry stalwarts, thousands of startups, and even some startups that quickly became monoliths when major players like Google and Amazon began investing in them. Seeing a $13 billion industry in dire need of innovation, Silicon Valley finally got woke. Now in 2019, shippers are faced with more options than ever. And for many, it's led to option paralysis. So, instead of talking about any specific tech today, we're going to look back on the last quarter in our transportation industry report, and then we will lay out some manageable solutions for shippers to consider if they'd like to save on freight in 2019 and start their journey towards modern supply chain solutions. So let's do it. Let's get to the transportation industry report. As had been the trend throughout 2018, November truck and intermodal pricing continued to favor the carriers as limited capacity and a volume rush to beat trade war tariffs keep growth strong. In fact, according to the most recent data from the American Trucking Association, FTR, TCI, IANA, Cass Information Systems, and Broughton Capital, although November's Cass Information Systems Linehaul Index didn't break the new all-time record set in October at 143.4, price increases were up 8.2% annually, coming to rest at 141.6. This continued a year-long streak of annual gains that began the previous year in November 2017. The Cass Report's author and former guest of this show, Donald Broughton, noted that this was still very impressive given the tougher comparison. With 11 out of the 12 months of the year reported, the Cass Report indicates that the realized contract pricing forecast for 2018 of 6 to 12% is essentially locked and in the books. The ATA's seasonally adjusted for higher truck tonnage index tells a similar story as it was up 7.6 annually in November, but was down half a point from October's highs. ATA chief economist Bob Costello shared his outlook with the following statement. The fact that tonnage rose in November after a strong October is impressive. It was likely due to some continued pull forward of shipments from China due to the threat of higher tariffs, as well as solid retail sales last month. With continued strength in November, tonnage growth is on pace to be the best year since 1998. While the Cass Report is also optimistic about the market's strength, it warned that there is still a chance for market uncertainty and volatility as new tariffs loom. Even with those concerns, though, Broughton notes that with oil prices low, at $55 a barrel, and no sign of an immediate economic downturn, thank the maker, pricing power should remain on the carrier side. Broughton writes the following in the Cass Report. Demand is exceeding capacity in most modes of transportation by a material amount. In turn, pricing power has erupted in those modes to levels that spark overall inflationary concerns in the broader economy. Given the higher price of oil, resulting in higher fuel surcharges, and the strength in rates being experienced in sectors such as flatbed and chemical railroading, it should come as no surprise that the Cass Freight Expenditures Index is reporting such overall strength in transportation spending. According to a report by Logistics Management, Costello explained his outlook for 2019 in a recent conference call hosted by investment firm Stifel earlier this year. 2018 is shaping up to be the highest level of production since 2007, and 2019 should be the highest on record, Costello said. If we look at year-over-year growth rates, we're going to go essentially no growth in the sector from 2015 and 2016 to 2.8% growth this year and over 3% growth next year. Cass has also updated their truckload pricing expectations to a lower range of 2 to 4% in 2019. While both the ATA and Cass see normalization and steady growth, FTR's Trucking Conditions Index, TCI, shows October's TCI at its lowest levels since August 2017, but despite that, the firm does believe that the outlook for trucking conditions does remain strong. Avery Weiss, FTR's Vice President of Trucking, he made the following statement. October's Conditions Index confirms the general sense that the current cycle has peaked. Although we anticipate improved conditions for the remainder of 2018 and much of 2019 compared to October, we appear headed gradually towards neutral territory. While many early reports blamed ELDs for a decrease in capacity, Broughton sees them as a factor in creating capacity, or more accurately, in creating capacity for shippers of choice who are in good standing with their carrier partners. Broughton breaks it down like this. Many blame the current tightness in capacity on the implementation of the ELD rule. We assert that is now only having a minor impact. We also know that capacity was already very tight before the rule went into effect, and that both the visibility of equipment and the measurement highlighting of bad shipper behavior has dramatically increased in the last 12 months. And that's those carriers leveraging their ELD data a lot. If you remember, were belly aching early on. They saw it as the end of the industry is going to put everybody out of business. That wasn't a monolithic super trucking corporation. But as it turns out, a lot of them are now leveraging that data to create capacity that they need, using it to their advantage, adapting. But that's the trucking market. How is the intermodal market faring? Well, a strong truck haul market typically means a robust intermodal market as shippers scramble to create capacity and get their freight moving. The Intermodal Association of North America, that's the IANA, and the Cass Intermodal Index both have impressive year-over-year growth in volume and rates respectively. IANA points to elevated container import volumes, heavy e-commerce demand, tight over-the-road capacity, plus elevated rates, driver shortages, and ELD restricted hours of service as the reason for a 5.4% year-over-year increase in total intermodal volumes. Cass reports a 10.6% increase in total pricing for intermodal carriers, with that momentum increasing. The report attributes intermodal volume growth to a tight truck hold capacity market as shippers are choosing intermodal to just get the freight moved. It's not a good value at the break-even point yet. Broughton predicts intermodal rates have room to continue posting year-over-year percentage increases in the coming months, but if fuel prices continue to decline, we expect the nominal rates to be under pressure. The firm's reasoning behind this is that there is a pretty clear break-even point where the number of miles freight needs to travel becomes cost-effective to place it on the rail. The higher the cost of diesel, the shorter the distance where such a move makes sense. With fuel prices on the decline, there's much less cost opportunity via intermodal for shorter lengths of haul, even with limited trucking capacity, bolstering current rates. But it's not 2018 anymore, right guys? It's 2019, and there's a great unknown of how exactly 25% Chinese trade war tariffs will impact container volumes. Considering that China represents 47% of U.S. container volume, IANA President and CEO Johnny Casey believes that tariffs could have a significant impact on ISO container volumes. And that concludes the industry report. As you can see, a lot of the same trend lines from 2018 are bleeding into 2019 as rates are still elevated and capacity is still crunched. But there's hope, and shippers have more opportunity than ever to leverage modern solutions and best practices in order to get ahead of the market and their competitors. It's a fact. Shippers who have been playing the spot market in 2018 have been paying more for freight than at any time in 2017. After a barrage of hurricanes and new ELD regulations sent rates soaring at the end of 2017, driver shortages and a booming economy have kept costs high and capacity low on every page of the calendar in 2018. Unlike in previous years, where competition to fill space drove a shipper's market, in 2018, demand is exceeding supply, which has shifted the balance of power. These new market conditions have left shippers lamenting rates they haven't encountered since the beginning of the decade. Broughton actually addressed this in his most recent report. With freight volumes up 6.2% and the expenditure index up another 12%, some economists believe that inflation is back on the rise. In fact, Bain & Company wrote in a recent report, deflation has allowed companies to improve their margins in recent years without significantly cutting costs. But inflation is back, and rising supply chain costs are starting to erode earnings. In boardrooms around the world, executives now realize that they quickly need to take stronger measures to meet their productivity targets. However, according to analysis from Broughton Capital, measures are already being made to right the system, and they don't see inflation as being an issue in their long-term forecast. In fact, Broughton says, and I quote, "We are confident that the increased spending on equipment technology and people will eventually result in increased capacity in most transportation modes. That said, many modes are continuing to report limited amounts of capacity or even no capacity at any price shippers are willing to pay." Unfortunately, for shippers looking to save now, all of the above solutions take time to implement, and such outlays require capital investments. With many shippers' transportation budgets already upside down, adding additional costs to an already strained supply chain may seem counterintuitive on the surface. Since shippers can't control the hiring process of their carriers or drastically change the freight market on their own, unless you're reading this at Walmart or Amazon, you may be wondering what kind of measurable difference you can even make. Well, as Chicken Soup for the Soul scribe Jack Canfield once said, you only have control over 3 things in your life: the thoughts you think, the images you visualize, and the actions you take. 2018 may have been a surprise to some shippers and a wake-up call to others, as many were unprepared for over 12 months of elevated pricing, drop shipments, and disinterested carrier partners. But fortunately, there are a number of things that shippers can do to make 2019 a much less costly and stressful year than the one that came before it. So here are some ways that you can start saving on your trucking freight right now, right here in 2019. The first, we stress it all the time on the show, it's data. There's no single greater indicator of the health of your supply chain than the data it produces and how it's captured. Well-managed supply chains produce great data, and great data is the gateway to nearly every aspect of supply chain modernization. Shippers who take ownership of their data and its capture understand that data isn't a receipt received at the end of a transaction. It's a mirror that reflects the very function of your transportation, inventory, and revenue in real time. You've heard the old adage, bad data in, bad data out. But as supply chains become more advanced, that same sage old saying has taken on new meaning. Dirty data doesn't just mean poor internal visibility, lost optimization, and cost-saving opportunity. No, it also cripples shippers who are interested in investing in AI, automation, blockchain, etc. None of these services can be leveraged in a meaningful way if the very information that informs, trains, and drives them is inaccurate, unavailable, or never even captured properly in the first place. Shippers who enter 2019 with a New Year's resolution to clean up their transportation data will unlock capacity via intelligent routing, reduce miles driven, and optimize savings, while allowing them to explore deeper cross-functional opportunities than their less proactive peers. Number 2, second place you can look, internally. Will most shippers realize that communication and visibility are core precepts of well-managed departments? Why is it that most departmental data is siloed in walled gardens? Successful leadership teams identify where departments intersect and use an integrated approach to cost management by uncovering savings opportunities across organizational boundaries. In fact, a recent report by Bain & Company recommends developing and analyzing data holistically across silos as a fundamental key to uncovering these opportunities. In addition, a cost czar working with cross-functional teams could be used to ensure accountability for results. Here's one you may not think about. And this is something that comes up if you're dealing with a 3PL or you're dealing with a carrier and they're managing your TMS system. And it's something to look out for. This is number 3. It's neutral optimization. I'll tell you what I mean by that. When's the last time that you took a deep dive into how exactly your freight is routed? You may be surprised to learn that your shipment routing just doesn't always make a whole heck of a lot of sense. The reason for that is that brokers and carriers have lanes they need to fill and sell. The result can be freight that is optimized for them, but not you. Since truckers have assets to fill, and many brokers are contractually obligated to sell space along specific routes, there can be clear conflict of interest between what's good for the goose and what's good for the gander. A transportation management system and other optimization tools are often best administered by a freight-agnostic firm that doesn't look at your freight spend as revenue and instead sees it how a shipper should, as cost. Number 4, relationship. Now that you've compiled your data and looked at different ways to move your cargo, it may be time to move out of the spot market and negotiate contract rates. Look, a volatile freight market creates a perilous environment for shippers as they risk paying exorbitant rates while waiting in line for trucks. There may be no better time than the present to start creating true business relationships with carriers. In a tough market, carriers are going to provide the best service to companies that give them clear rules and responsibilities and then adhere to those guidelines that they have laid out. Those are their shippers of choice. Number 5, negotiate. Contract season's coming up, folks. It's time to put on the boxing gloves and get to negotiating. Once you've tidied up your data, you'll also be able to use that information to leverage these carrier relationships. The carrier world is always trying to create as much of a forecast as possible during negotiations so that they can understand what your value proposition to them is actually worth. Your trend lines are invaluable to carriers and should not be dismissed during negotiations. Speaking of data, this would also be a great time to discuss with them your new requirements for data capture. As you solidify these partnerships, you may even want to rethink your approach. It's very common for the shipper-carrier relationship to be highly focused on the ones and zeros at the bottom of the rate quote. Well-managed modern supply chains understand that the ones and zeros that matter the most are digital and reflect your supply chain. Knowing those ones and zeros means paying a lot less of those other ones and zeros. Looking to modernize, digitize, and future-proof your supply chain? Visit day1.io for a free Day 1 Data Optimization Report. That's day, the number 0, the number 1.io. Isn't it time you got optimized? Announcing on October 10th, 2019, Aborn & Co. presents TransTech 2020, a supply chain vision and innovation conference. This event is the first of its kind in Boston. Join our panel of speakers from the worlds of logistics and technology as we discuss the modern needs of the supply chain and the merger between the physical and digital footprint that freight creates. Head on over to transtech2020.com for more details. We'll be talking about AI, automation, autonomous vehicles, blockchain, data purity and capture, future-proofing the supply chain, market conditions, transportation management systems, and so much more. Head on over to transtech2020.com for registrant and sponsored details. If you have any questions, comments, suggestions, feel free to email me at tdooner@abornandco.com. That's TDOONER@abornandco.com. I'd be happy to learn something new with you. For this episode and all of our previous shows, visit consultinglogistics.io or simply search for Consulting Logistics on iTunes, Spotify, or your favorite podcast player of choice. And hey, if you like the show, the best way you can give back is to share it. And if you really liked it, go on iTunes over there and rate and review. Be much appreciated. I know this was a quick one, but that's it. We're out of time for this week. Happy New Year, everybody. Best wishes and best of luck in the market in 2019. For Consulting Logistics, I'm Tim Dooner, saying take care and happy shipping.